All right. Well, welcome everybody to ESIG's Market Design Meteorology Workshop. Technically, the workshop will start this afternoon, but glad that you all came here to join this tutorial this morning. We've got a lot of material for the next few hours up until lunch, and really want this to be interactive. So please interrupt with any questions throughout the session. Before kind of getting into this, I want to check the room just for sort of who we have here. Utilities, ISOs, RTOs, consultants, software developers, research labs, universities. Okay, international folks outside of the US. How many of you would consider yourselves meteorologists or forecast experts? Okay, great. Well, we've got a very diverse set of folks in the room today. I hope this will be. I believe it'll be really useful for all of you. We'll kind of do a lot of introductory things, but also get into the details. So even our ISO RTO colleagues, I think, will get a lot of value out of this, and also try to give this international overview, and which is something that I think at this tutorial, we tend to focus on the U.S. side of things, and say we'll get a lot of interesting differences across U.S. and Europe. So I'm excited to talk through that. So with that, we'll get started, and I just want to introduce. Well, here's our agenda. Before I introduce my fellow instructors here, we'll start with the introduction, what the objectives are for the rest of the session, then kind of talk about market structure. So again, we're really talking about markets, market operations, sort of the integration of operations and markets. We'll talk about operational procedures, kind of the timelines associated with these different electricity markets. And then we'll talk about forecast integration. I think good to see so many folks from the meteorology and forecasting side to talk about where do these things go? Where are they used? So we'll have that as part of the agenda. Talking about grid services, ancillary services, reliability services, how they're used today, what are they, and maybe how the markets enable their procurement and efficiency of those services. And then really close off this morning with how are things moving? What's with the energy transition? How are all these things that we've talked about in these previous modules? What's happening to the evolution of all of these different services going forward? So that's what we have for the agenda. So first introduce myself, Erik, and I am Director of System Operations and Electricity Markets here at ESIG. Actually was thinking this morning that this week is my 20th year anniversary for the industry. So 20 years ago, started working at an ISO, and then basically became really focused on these topics for the last 20 years. But worked for EPRI for the last 10 years. Worked for Research Lab, and before that in an ISO. So happy to participate in this and looking forward to it. And then I have two colleagues here. So Yonghong Chen is a chief scientist of the Grid Planning and Analysis Center at the National Renewable Energy Laboratory. She joined NREL in 2023 after spending 20 years at MISO, leading their R&D. So anyone that's seen or heard about market design changes and market software changes, Yonghong had some hand in almost all of what had happened there, even at other ISOs, and she was always a collaborator across those ISOs. So I got to work for many years with Yonghong and still do. And she holds a PhD in electrical engineering from Washington State University and is a fellow of the IEEE. And then we also have Gillain. So, and we're happy to have Chen here from Europe, which really will help give some of those comparisons, just understanding. So a lot of us think, well, their markets are different, their operations are different, but there's also a lot of similarities. And I think Chen will share a lot about what those are, as well as some of what those differences are. So over the past 3 years, he's worked with the R&D group of the Pan-European intraday and day-ahead electricity markets at ENSIDE, and recently led the opening of ENSIDE's office in Japan. So could perhaps share some interesting tidbits about Japan's electricity markets and operations, how that differs over there as well. And he's now responsible for expanding ENSIDE's activities across Europe, APAC, and the US. So we're all delighted to be here. We've kind of integrated these slides together, so we're going to kind of be swapping back and forth within the slides to kind of bring all of this together. And like I said, really want everybody to interrupt. It's a fairly small group, so we do have some pause points for questions, but that doesn't mean you have to wait for them if you have a clarifying question or really want to get into some detail on the slides that you're seeing. Raise a hand or go up to the mic and and just ask away. That's really what we want these tutorials to be like. So with that, we'll get right into it. How you guys comfortable with this standings, or how should we? Or we could all, yeah, maybe we could bring chairs down here, and then we can just kind of. As long as you don't make any fire hazards. And just grab the mic so we can pass that around too. Let me ask, just to get people talking, from this agenda, is there anything that you didn't see on this agenda that you would have liked to have talked about or would have hoped to have talked about? Okay, good. So we, and as you're seeing things, definitely let us know. We have, there's a lot of experience across the three of us here, and I know we've got colleagues in the audience that can chime in on certain things, so if there are questions. But this is what we had for the objectives of today. And, very similar to the agenda, but what did we want to make sure that you all heard? So first, going over market structures and designs, understanding what the basic difference is across the US regions as well as US and Europe, who has the responsibilities across the operations and markets. Then talk about operational scheduling practices. How do system and market operators schedule their resources at different timeframes? Then talking about forecasts and the application of those forecasts. Where are these different renewable and load forecasts used? How are they used in different applications? And then what other types of forecasts are there? And what are we using as inputs into these markets and operational procedures? Then going through grid services. Oh, question, sure. Yeah, they'll be posted with the slides of the conference. Yeah. Grid services, so understanding what the grid services are across North America and Europe. Also talking a little bit about the markets that procure those grid services, who is providing them. And then finally, as I mentioned, the forward-looking evolution, kind of after talking about all these different topics, what are some thoughts that the three of us have in terms of how things are evolving in the next 5 or 10 years? And really try to help you all, and maybe get some thoughts from the audience here as well about, where do you think these operational strategies and markets are evolving in the future. So let's get right into it with market structure. So, there's some different definitions out there, but many of us think of market structure as kind of who has the responsibilities and how are they connected across the different regions. So there's a lot of different structures that are in place. Actually, there's a lot of different structures within the United States, as we'll show here, but going through a few of these. So in the Northeast region, there's been restructuring in many of the states in the Northeast region, but we tend to see across all of the US market regions, the ISO the market operator and the system operator are one entity, the ISO or the RTO. So we'll see that may not be the case in all situations, but we have that one entity that's operating the market as well as the system. And then we have a transmission owner or as well as a distribution owner, and those could actually be separate as well. And then a supplier. So the market participant, the resource that's supplying energy, are separate entities in these restructured regions, primarily in the Northeast US, but also in Texas and other parts of the country. And then some of the other regions in the US, for example, in the Midwest, you have, again, an ISO RTO that is operating both the market and the system. And in many of these regions, and essentially the states that didn't have restructuring, where they still have vertically integrated utilities participating within these wholesale markets, that transmission owner and generation supplier are one entity. So they're owning the transmission and the generation, still competing with other utilities and participating within that market. So that's kind of a structure that you see within those regions. Within the European regions, and Jean will talk more about this, but they have a little bit of a different structure where the market operator is actually in most of Europe, I think with the exception of the UK, the market operator is separate from the system operator. So you've probably heard of TSOs, transmission system operators, and their role is real-time balancing. They have some market functions, but really there's a separate market operator, like the exchange, like the European Power Exchange, that is responsible for the bulk of the market activity. So that entity is separate. But it also is cases that TSO often owns the transmission within its region, which is different than the US ISOs as well. And pretty much most of Europe have separated the supply side from the transmission and distribution side. And then in US non-market regions, there's another structure where we have fully vertically integrated utilities that are responsible for system operations, balancing functions, transmission operations, and transmission planning functions. And that entity also owns the transmission, typically would also own the distribution, as well as the generation that's within that region. So really full vertically integrated across those three functions. And there doesn't exist a market operator. There's no market in at least some of these regions that we're talking about. So just kind of there's really wanting to show there's a lot of differences across even the US, but looking at the whole world, you'd see many different structures out there, who's responsible for what, and how they may share responsibilities as those different entities. One other piece that sometimes gets paired together with the leftmost structure, but can have some differences in certain regions, and that's looking at the who's supplying the loads, who's the entity that is providing that retail energy to consumers. And so it could be that in some regions without retail competition or without retail choice, that the local utility is the single entity that's also the retail supplier in that region. Or it could be that entity is split. You have a transmission owning entity as well as a load serving entity such as a retailer that has that additional or that separate responsibilities. So a lot of different ways you can put these puzzle pieces together. What's important about this is its structure. This is not something that a FERC would be responsible for. This tends to be through state legislation and decisions within that state or within that country. And we kind of look at this as, well, this is something that's fairly fixed. It can change through legislation and has changed. But we try to think about what's the right market design and operational strategies given these structures that we have as part of the system. So getting into a little bit more of the design side of the U.S. markets, and a lot of what I think we're sharing as part of this is just to show how much variety and how many differences there are. And we'll talk about how many differences there are within the United States. And then, of course, looking at it internationally, we'll see how much variety there is too. So I'm going to try to build up the types of markets that exist today, and you'll kind of see a little bit more about how those differences are. So first, kind of the basics is having open access transmission tariffs. Really that's something that's part of all the U.S., even in the regions that do not have a market. If I went another layer above this, for example, the existing Southeast Energy Exchange market, where they have a platform for price transparency, right? So there's a platform in the Southeast, and kind of already in the last slide showed there wasn't really a market operator in the Southeast. That's maybe not true depending on who you ask, but there is the Southeast Energy Exchange market. It actually was clarified and approved by FERC this year, again, after some rehearing. But this is a platform so that the utilities in the Southeast can transact with one another, and there's a way to see what those prices are that are transacting. With another layer up, we might have the energy imbalance market in the Western U.S. or the energy imbalance service in the West. And so this isn't an ISO or an RTO. It's really a mechanism to transact energy in the real-time basis to balance out any deviations that are happening between when the transactions were first settled and what's happening in real time. So these are efficiently formed prices, so that's kind of another layer up, and a mechanism for managing congestion within those regions. But again, it's very small amount of transactions happening. Most of those transactions in those regions are happening, prior to these real-time markets settling or clearing. So if we went another layer up, a greater volume of those transactions, we might have the extended day-ahead market in the West, or Markets Plus, maybe some of you have heard, which is SPP's day-ahead market proposal. Both of these have not started yet, but are planned to in 2026 and 2027. And so again, we're not an ISO or RTO yet, but a mechanism for different entities in these regions to be transacting with a greater volume of energy through these day-ahead markets. So the next layer up would be an RTO, an ISO. So now we have a consolidated balancing area, balancing authority. So all of the balancing happening within one region. We have ancillary service markets, co-optimizing those with energy markets. We have a planning function that is part of the RTO and ISO responsibility. And, so all of that sort of ISO functions that you hear of are what we've built up on top of that. And this is where I would say, SPP, MISO, California ISO would fit. And if I were to just go one more layer up, is where, similar to the last slide, I'm now adding that divesting from generation and the transmission or we have the ISO RTO, we have restructuring, we have retail competition, and we have centralized procurement of supply resources that, markets functioning as a way to make some investment decisions. And that's where we'd have Northeastern ISOs. Even though ERCOT does not have a capacity market that we know, I'd probably consider that on this top one as well, with the restructuring that they have in the retail competition. So again, a lot of different layers of what functionality is part of the different markets, and trying to show that there's a lot of variety out there. And of course, we haven't even gotten to some of the differences with Europe and other parts of the world. So this is I've been kind of showing these things and these differences in a couple different ways. So I want to show it in maybe one other way here. And that's talking about retail electricity markets and how they compare and how we look at retail and wholesale together. because these are two different things, right? They typically, you think of retail and wholesale as being aligned. You know, Walmart would know how retail markets work and how wholesale markets work. But in electricity, there's quite a lot of difference between how these retail and wholesale electricity markets and rates work. So first, and this is a poor attempt, and at some point we'll get some graphics people to improve this, but this is a map of, for now, please just look at the dark blue and the striped states, okay? So those states have, and assuming this is up to date, which sometimes it can change, but the dark blue and the striped states have retail competition. They've deregulated their electricity market. So now I'm going to plop on top of that the ISO RTO map. And so it's really going to be hard to see, but there's some unique things happening here. So first we have, you know, some of these regions where there's no colors. You know, they don't have the dark blue or the stripe, and they also don't have the ISO there. And the way to think about that is, in these regions, there's only one grocery store in town, and they source all their food, all of their products from the same farm, from the same provider, right? So you as a customer, you go to the local grocery store. It's the only place you can go, and you know where all their food's coming from. It's coming from the same farm, same factories, et cetera. So, and then another option, you can see there's the, we have states without that retail restructuring, but that are in an ISO RTO. So it doesn't have the dark blue or the stripe, but you can see there's a region there within SPP. So in this region, there's only one grocery store in town. So I have to go to that one local grocery store. But that grocery store, you know, is trying to find some other products. It may have a couple different farms. It's trying to find the cheapest groceries from those farms, from those factories. So it's only one grocery store, but it's got a couple different options where it's getting its supply from within those within that one grocery store. And then you have these other regions that are part of the stripe, part of the dark blue states, but also part of the ISO RTO maps. And in those regions, I can go to any grocery store I want. You know, there's a couple different options. Maybe they each give different coupons that I can find, or some of them have better deals or better products. And all of them are sourcing their products from different farms and different factories. So, you know, just another layer on top of here to show that there's wholesale markets and sort of that restructuring from the wholesale side and restructuring from the retail side that aren't one and the same. They're not sort of coinciding with each other. So just another way of seeing what that is. So I'm going to hand over to Jean now.
Does the mic work? Mic work? Yes. Okay, perfect. Maybe I might.
That works now.
Yeah, but just.
Oh, sorry. Yeah.
Yeah, sorry. So hello, everybody. Before going into more details of how it is in the European markets and the different schedule of the European market, what I can tell you is that I might be using some European acronyms. If you don't understand them, I will try not to use them, but if you don't understand them, let me know, raise your hand, and I'll explain them. So the first difference with the US market, mainly I think the most important one, is that we separated the market in a market operator and a system operator. Some of you might remember, it was already 20 years ago, that's something you had in California. I heard that by speaking with Erik this morning. But so we separate the market and the system operation in two, meaning we have power exchange that are responsible to operate the market, while on the other side, we have TSOs, also called transmission system operator, that are responsible to operate the grid. So mainly the physical security of the grid, the stability, and the reliability of the grid in real time. What power exchange handles, it's mainly bids and offer for electricity. So it's really on the market side, it's just energy. While transmission system operator, what they handle is the physical electrical flows and ancillary services. I see there is an issue on the slide, maybe it was not, no, okay, sorry. And how power exchange receive money is mainly from transaction fee from the market participant, because market participants to participate into the market, they have to pay transaction fee. Something similar, I think, in the US when they participate in ISO's markets. While transmission system operator, how they receive money, it's from the grid access charges, grid fees also called. The timeframes where power exchange work is mainly in day ahead and intraday, where there are different markets that are operated. They also provide some platform to allow for exchange more in forward markets, while transmission system operator, where they mainly operate, it's in real time to redispatch, to activate some ancillary services, balancing energy. And in Europe, it's something you're going to see all over the presentation. What we try to do is to cooperate between the different European countries together at the power exchange level, but also at the transmission system operator level. And power exchange, they mainly work together through the market coupling, meaning there is only one market for whole Europe. I'll go through it a little bit later. And transmission system operator, they also work together. And that's done through NSOE that you may have heard that handle the cooperation between the different transmission system operator all over Europe, but also thanks to regional operational center, which is more centralized. Only a couple of transmission system operator that work together on neighboring countries. Maybe that's.
Yeah, okay. So this slide summarizes the electricity market timeline in the US. So our tutorial focuses on the operational side, but many things happen way before operations. For example, there's a long-term purchase agreement. It's an organized market for that. This is really important for independent power producers or these renewable developers. This will provide the bankability, for them to get financing for the new renewable project. And then after that, for the ISO RTU, some of these regions has the 3-year forward capacity market, like PJM or ISO New England. So this 3-year time frame really is important for building gas generator. So also provide them some financial certainty to get the finance for their new project. But in most cases, this capacity market is like a prompt, like 1 year ahead or months, like a 1 year annual clearing or seasonal clearing, like months is ahead. And then on the transmission side, the financial transmission right auction is really to allocate existing transmission capacity and also provide hedging for the day-ahead congestion. The FTR market is usually like an annual auction, but there's also monthly incremental auctions. When getting to day-ahead, most of the generation, the commitment decision are made in the day-ahead market. So it's in most US ISO RTUs, it's the energy and the energy service co-optimization. So the market will clear, all these products together, with a market clearing price. But really before that, a week ahead, most of the ISO RTU has a non-binding commitment process, really to make sure there's a sufficient supply in the week ahead and also commit long lead generator if it's necessary. And after they have market in the intraday, there's a continuous like incremental commitment in the intraday market commitment process. But most of the time, there's no kind of multi-interval or hour ahead price. The real-time market is normally, every 5 minutes on security constraint economic dispatch, and then that will give real-time price. And in most cases, real-time market is also co-optimized, with energy and energy service all cleared simultaneously. And also in the US, with the nodal market, the congestion, transmission constraints also co-optimized with a nodal price. This is an extremely important tool for market operators to manage congestion. Like for this large system, like MISO or PGM, it could have very large number of congestion. And then these market operation tools provide a very powerful tool for operators to manage this large system. And then finally, after they have market, there's ex-post pricing. In most of the US, later on we'll discuss, it's a so-called convex pricing or extended L1P to really address this non-convexity, because L1P gave the marginal clearing price, but a lot of the generator has fixed cost. And this ex-post pricing process, we're trying to generate a price to be able to cover some of these fixed costs and then give a right kind of price signal for investment. And then after the market clearing, the settlement, the first round of settlement normally is based on the status estimation result, but the participant can later on submit the meter data and then do the resettlement. And sometimes they may also submit a dispute. And occasionally I also need to rerun the market or pricing to correct some of the issues. So this is like an overview of the whole electricity market timeframe in US.
So now let's have a look at the market timelines in EU. In terms of forward markets, it's kind of similar, the US and the EU. What really begins to be different is mainly in the ahead. But so in forward markets, we also have PPAs. One difference that we have in Europe that I don't think you have in US is CFDs. So it's kind of similar to PPAs, but it's not between private parties. It's within a generation party and the state. We have financial transmission rights markets, which really is financial markets for difference of price between different countries. Option on that, and also obligation. We have physical transmission rights, where there it's really rights to provide electricity on the head market or in real time. And we also have balancing capacity product, can be long-term. So balancing capacity product is what you call ancillary services in the US, and those are procured via the TSO. Then we have what happens in the ahead through the coupling, so the European day-ahead coupling, called also SDAC. What happens is that 10 a.m. TSO, they need to provide the available capacity for the market that's published, and all market participants have access to it. At 12, it's gate closure, so meaning market participants cannot submit bids afterwards. And the output of the market clearing algorithm in Europe are hourly clearing price and also market results, so meaning the volumes that are accepted and refused for each market participant. And then after the ahead, so it's after 1 p.m. In the ahead, we have what we call the single intraday coupling. So there, it's market closure on previous days, but we still have market interaction which are operated via the power exchange. It's really exchange that happens during the day that can be done via auction or continuously over the day. And it's really a market through the day until delivery. And then in real time, that's where system operator operates. What they do is mainly imbalance netting, and they procure balancing energy. So ancillary services activate ancillary services in real time. There are different types of reserve, frequency containment reserve, frequency restoration, and replacement reserve that they can activate in real time. But so really everything that's in real time, it's what TSO operate, while everything before is mostly what power exchange operate. And what I forgot to say is for forward market, transmission system operator also operate there. They have capacity market, capacity remuneration mechanism, but that really depends from one country to the other. Most of them begin to adopt it, but still are resilient, similar a little bit to what you have in the US with ERCOT. And now what I was saying is mainly what happens in Europe and where there is the most exchange is in day ahead. And so in Europe, I was saying we have one single algorithm and one single market for whole Europe for energy. So all the power exchange, they cooperate together to create one single market. It's more than 26 countries. This market had its 10th anniversary 1 year ago. Initially, there were only 16 countries. Now there are 26. The purpose is to even have further countries participating into it in the future. We might get to 35 by 2035. So those are the objectives of the market. And so this is really the cooperation between the different power exchange. Initially, there was one power exchange per country. Now it's a little bit different. There are some countries which have multiple ones, but still some countries where there is still only one power exchange. And it's also with the cooperation of TSO, Transmission System Operator, where often there is one transmission system operator per country. And the reason why I'm there mainly is because Inside is currently operating this market, providing R&D, trying to improve it. So we've been doing that for more than 10 years. So now 11 years since it starts. And that's really what brings a lot of value to Europe because, for example, in the Nordics, we have a lot of dams and a lot of dams, while, for example, in Germany, we have another type of mix. We have more gas. In France, we have more nuclear. In the south of Europe, we have a lot of renewables, mainly solar. And this market allows to have exchange between those different countries. This brings quite a lot of values. The average welfare per session, so per transaction every day, is around 11 billions of euros that are exchanged. And the amount of volume that was traded per year, it's around 1,700 terawatt hour. So it's really the biggest market in the world. No, I think this is.
Oh, yeah.
Yeah.
All right. So, to finish this first module up, what Jean and I are both going to do is talk about, some of the common characteristics of U.S. electricity markets, some of the unique ones that differ across those regions. So again, doing this in so many different ways, and doing the same then for Europe and the different European countries. So U.S. electricity market design in a nutshell. So the independent market operators do not own transmission, so that's something we already had talked about. Nodal pricing for supply. So all of the US ISOs have nodal pricing for the generators for all the suppliers. This is actually now the case in Ontario as well. They all use security constrained centralized commitment for their day ahead commitment process that's linked to their day ahead market. And they all have 5-minute security constrained economic dispatch, which is managing congestion, dispatching all of the resources participating in that market, and also computing those nodal prices for the suppliers. Day-ahead and real-time markets for energy and ancillary services, actually in December, this will be true for all the US markets. ISO New England just added a day-ahead market earlier this year, and ERCOT will be adding their real-time ancillary service market in December. In California, ISO sort of has a real-time ancillary service market, but all of the regions have day-ahead and real-time energy markets. Maybe a term that I made up, and Yonghong can correct me on a better terminology, but all the ISOs use 3-part offers, which includes energy, incremental energy, startup costs, and no load or minimum generation costs, and what I call partially convexified prices. So they incorporate those 3 costs into their price in different ways, very different ways, depending on the region. But they all have some version of incorporating those costs, as well as incorporating prices for resources that might be constrained that couldn't otherwise set the price. And they all have make-whole payments. So make-whole payments, if If you did not receive sufficient revenue to do what the ISO has directed you to do, there are various make-whole payments to cover those operational costs. All of the regions have technology-specific participation models. So things like the generator participation model, renewable resource participation models, energy storage resource participation models, really kind of getting that technology characteristics so that they're built within the market clearing. I think that's another difference we'll hear between the US and Europe. Co-optimized active power short-term ancillary service markets. So the reserve markets in all the ISOs co-optimized with the energy markets. This is something we'll talk more about, I think, after the break. And that's one of the boxes that we'll dive a little bit deeper into. As Yonghong had been mentioning around the transmission rights, all of the ISOs also operate financial markets. This includes markets for locational price hedging, so financial transmission rights markets, transmission congestion rights, congestion revenue rights. There's a lot of different names, or the FTR markets, but really kind of a way for transactors to hedge against volatility that might be happening across the supply side and the load side. And there's also financial markets for day-ahead real-time price convergence. So folks have heard of virtual trading, not virtual power plants, virtual trading. Inks and DEX are another name, so a way for there to be a financial mechanism to provide that convergence. All the ISOs have this as well. And reserve shortage pricing. A really important part of the market design, providing both short-term and long-term incentives. All the ISOs have some administratively set value. If the ISO is short on a reserve product, the price will rise, typically above the marginal cost of any supply resource that exists, and that will also impact the energy price. Yes.
Can you clarify what's the difference between the energy/power and what are
Yeah, well, we'll have a whole module on that after the break, but really I'm talking about, what are the things that are ancillary to energy that are supporting reliability of systems. So things like frequency control, voltage support, having reserve capacity in case an event were to happen. So it's all, and you'll see there's a chart that I've been showing for many years on all of these different types of categories of ancillary services. So we'll talk more about that, but really we're talking about all of these different operational grid services that are, sort of in addition to supplying energy. So these are, and this is not exhaustive, but these are 9 things that are really common across all 7 electricity markets in the United States. Here are some unique things. So things that, maybe exist in one region, but not the others, but just some really important things that differ across all those US market regions. Whether they have capacity markets, whether those capacity markets are short-term, a few months ahead or a few years ahead, or whether they have them at all. Demand response participation. This differs quite a bit by each region. Different states may have different retail rules, as we talked about before, different rules, whether the state opts out of having third-party demand response. There's a lot of differences, and then just the ways that these demand resources participate in the market can differ quite a lot across those regions. Clean energy policies. Obviously, this is more of a state driven difference than an ISO driven difference, but different states have different policies and incentives for clean energy or for other technologies, and that has an impact on the electricity market decisions. Mitigation procedures. So, one thing that goes hand in hand with nodal pricing is automatic mitigation procedures. So if there is a resource that has market power in a part of the grid that is constrained and it can otherwise set the price to whatever it wants to set the price at, there has to be these automatic mitigation procedures. But those differ quite a lot. Some RTOs have what are called the conduct impact tests. Others have the 3 pivotal supplier. Sometimes they have, look at whether there is an impact or just have a mitigation that, mitigate the bid to cost offer regardless of what that impact is. So there's quite a lot of differences on how the mitigation procedures work across these regions. Whether the individual resources participate in the market or if they have sort of aggregations through these scheduling coordinators is another difference. The intraday scheduling processes. So Jean talked about, Europe has this full integrated intraday market. That's not in place in any US markets today. So there is no intraday market that's, liquid market and that's run by the ISOs. But each of the ISOs have different, they're not just saying, okay, day ahead market's done. We're going to go, shut down the computers until it's 10 minutes to real time. They're doing other things. They're making sure that reliability is maintained. There may be intraday commitment processes that are just turning on a unit if it's required. There's several different procedures that are happening within that intraday time frame, and these differ quite a lot by region. Whether they have these short-term flexibility products, that's a big difference. A few ISOs have what are called ramp products or flexibility products. Others don't, and they have different definitions of what those are. I talked about shortage pricing. The reserve shortage pricing is something that exists in all of the ISO markets, but how that shortage pricing is developed and, sometimes they'll have a curve for shortage prices that might decline the less short you are. Other times the value differs by quite a lot across these regions, but there could be some substantial differences on the design of that shortage pricing for being short on operating reserve. And then performance penalties. And this could be performance penalties for capacity markets or performance penalties for not following energy dispatch. There's substantial differences across those regions. So a lot of content here. Some of the stuff I talked about, we'll talk in a little bit more detail later on. Some of this we won't talk about again. And we're happy to answer any questions on that. But maybe we'll hold questions, and Jean's going to talk kind of doing the same thing for European markets, and then we'll do a long pause for questions.
Maybe I have a question for you before. When you speak about performance penalty, you mean imbalance prices are not the same from one ISO to the other?
No. Here performance penalty. So we have, obviously the day ahead in real time. So if you adjust your day ahead position in real time, you'll settle based on the real time price and the deviation in real time price. I don't call that a performance penalty. That's a change in conditions. But in PJM and ISO New England, they have some designs where if you sold in the capacity market and there's a critical condition, a resource adequacy condition, and you did not perform, they have some substantial penalties for those resources. And there's also, if you get a dispatch signal, a real-time market dispatch signal, and you deviate from that, there's various ways of penalizing resources for that that's separate from the market.
Thank you. So now let's move to what's common in Europe. I'm sorry, my skills to animate are not as good as the one as Erik, so everything pops up at the same time. But maybe the first block that we already discussed about is that transmission system operator in Europe, they own the grid elements. It's different to the US, where ISO do not. In Europe, and I think that's way different to what you have in the US, is that we have zonal pricing. So something you had quite in the past in the US, meaning often we have one price per zone, and a zone, what does it represent? It represents countries. So it does not represent all the transmission constraints. They are not represented within the market. We have the spot day ahead markets, and our market time unit, it's 60 minutes for the moment. It's going to move to 50 minutes very soon, and something I'll discuss at the end of the presentation with the improvement going on in Europe. But for the moment, it's still 60 minutes. We have separate day-ahead and intraday auction for energy and ancillary services. So we don't co-optimize ancillary services and energy. And related to the question you had before, ancillary services in Europe, what I'm often going to say, I'm going to discuss about balancing energy or balancing capacity. We don't have free part offer. We have portfolio bidding in Europe, meaning the bids that are introduced into the markets, they do not exactly represent the physical constraint of the thermal power plants or of the power plants in general. It's something very rough. It can be aggregation of multiple power plants, but often, I mean, the most simple bids that we have in the market, it's simply a volume and a price at a certain period. In Europe, so we have one single market, at least for the wholesale market. We have pay as clear mode, and we don't have paradoxically accepted orders. What does it mean? In Europe, we don't have side payments after the markets. The price that is published by the market is the one at which you're going to be remunerated, and the power exchange won't add additional fees on that. So no one can lose money on the market, and that's one of the conditions that we have for the price. I don't know if it makes sense because it's really different compared to what you have in the US. We still try to maximize the welfare, have the most exchange as possible if you want in general, but we find price that makes such that no one lose money. So it's an additional constraint. So, yep. Aside from that, we have one common, I mean, not one, we have different common European balancing activation market. So market for ancillary services in real time. There is one single one that is the same for all the TSO, and they cooperate together. And that's something I think Erik didn't speak about, and I suppose it's a little bit similar in the US, but we have complex governance. So all the European countries, they work together to have one single market, but they have national regulated authorities, one per country, because we still, I mean, the power market is still regulated, and it's regulated at the country level, but it's also regulated at the European level. And so those regulation needs to work together, the national authorities and the European authorities. So that's common for whole Europe. Now let's look at what is different from one country to the others. European market design and what's it's unique across countries. So yeah, I already spoke about that, but in Europe, we have different bidding products from one country to the other. It also, yeah, I'll go through that later on. I was saying we have common balancing energy markets, but we have national energy balancing capacity markets. So that really depends from one country to the other, which is really to secure ancillary services in advance. Often it's done in day ahead. Similar to into the US, we have clean energy policies that differ from one country to the other. That differs, and that's quite normal because we don't all have the same energy mix. We are not regulated the same way. We have different national regulation authorities per countries. We have different power exchange. So initially there was one power exchange per country, and each country was operating its own market. Sorry, but then at certain time the EU pushed such that we have one common market, and power exchange begin to move. For example, in Belgium, initially we had Belpex that was bought again by EPEX, which is another power exchange. But so now what we have is we have different power exchange per country. Some are in some countries, there are only one power exchange. In other, there is competition for power exchange. So competition to access the market. In France, it's, for example, the case, there is Nord Pool and EPEX, which are the two biggest power exchange in Europe. And then we also have some difference in the number of bidding zones and regions that we have that are represented into the market. Some countries have only one bidding zones, meaning one price per market time unit. Others do not. It's, for example, the case of Italy, which has 7 different bidding zones. And why are the different bidding zones? So the first hypothesis, which is false in practice, is that in one bidding zones, there is no congestion. And so the output of the market will be what's going to happen into the grid, which is not true because, yeah, we do not reflect all the transmission constraints within the zone. I mean, there might be congestion internally within one zone. And if that happens too often, what can happen is that within a market, you separate your country in multiple bidding zones to better reflect those internal congestion. Of course, that's really a political question because it would mean different market prices per country, and some countries are not really happy to have that. For example, maybe you have heard about it, but Germany, just to redispatch the output of the market, it costs it more than 2 billion euros a year. And so the European regulation stated that they should split the countries in multiple bidding zones, but it's not something Germany is willing to do simply because it would mean different energy prices across the countries. The redispatch methods are different from one country to the other, mainly because they don't have the same grid assets. You are speaking about capacity markets. We call that capacity remuneration mechanism in Europe. They are different from one country to the other, mainly the design. And why so? It's because in Europe, we really try to work in a cooperative way. The purpose for the moment is to have capacity remuneration mechanisms per country. In the end, I mean, the final purpose would be to have one capacity remuneration mechanism all over Europe. And so what we try to do is to do kind of some tests in different countries, some different market design to see what's going to work the best. And then we have capacity calculation methods that are different from one country to the other. So the capacity calculation methods are the methods that are used to indicate the available transfer capacity from one country to the other into the market. So we have ATC, which is really the basic way, and we have flow-based methods, which is similar to what you have in the US to represent the grid constraint at the nodal level. It's PTDF constraints, but at the zonal level. So we aggregate the PTDF constraint from the nodal level at the zonal level, meaning we show the interdependencies in flows between the different bidding zones into the market.
Module here and probably get a little bit through it before we take our break. So I think I'm going to start with one, and then Yonghong, I think I'll hand it over to you for most of this. So, you know, really the next module talking about the timelines and, you know, where are different scheduling processes happening, when are they happening? So to start with settlements, again, you're going to see a lot of this, just the variety of what's out there, particularly around the world. So in most US markets, I mentioned in the common slides, we have day-ahead markets and 5-minute real-time markets. Hourly day-ahead, 5-minute real-time. So that's where those settlements are happening for energy. In you know, California ISO, they have this additional settlement that's happening with the 15-minute market in between those. So it's kind of has a 3-settlement system. In Europe, as Jean has mentioned a few times, we have the day-ahead market, these 3 intraday markets that are occurring, and then the balancing platform. So kind of a different way of looking at where those settlements are occurring. And then there's some other you know, designs out there. I know we've got at least one person from AEMO here this week. So the Australian National Electricity Market doesn't have a day-ahead market. It only has a real-time market. So all those settlements are only happening on the real-time. Same with Alberta, at least at the moment. Or maybe that's the design, yeah. Or in some other regions, like in Korea, there's only a day-ahead market. And everything in real-time is actually done more on a cost-based service. So again, there's some differences out there. There's some reasons why these have happened, but you know, looking at it from that, when is energy being settled at which time frames? So I'll hand it over to you.
Yeah. So these slides basically show the the operational process for managing uncertainty. Really, this kind of uncertainty management process start probably all the way from long-term planning. So in many of these areas, the state and the member utilities, they're responsible for the resource adequacy, especially on the longer term, like 20-year or 10-year time frame. And then there's the state policies. And then the ISO RTUs normally work closely with their member states to, you know, ensure the reliability. But really, you know, their main responsibility include like transmission expansion, Especially recently, there's a FERC order 1920, require all the ISOs to establish this long-term transmission expansion process and also consider this multi-scenario and, also like extreme event, in their planning process. And then when getting into like a 5-year time frame, there's a generation interconnection. So we all know there's a kind of crisis, with this long interconnection queue. It really ISO need to study, make sure there's enough transmission, and then if needed, we need to have like an incremental transmission upgrade, but these costs are allocated to this new generator. And then an important piece we covered earlier is still on the resource adequacy, but in a kind of more near-term time frame, 1 to 3 year forward. And even in the areas like without capacity market, the ISOs normally also play a critical role, working with state and the members, defining like a planning reserve margin and also methodologies on the capacity accreditation. So those are in the planning stage to ensure the system have enough transmission and generation to serve load. And then the operational process normally start like a week ahead. And most of these ISO RTO has this multi-day commitment process. Even though it's not a market, but grid operators want to, make sure there's a sufficient capacity in week ahead time frame. And then if necessary, they will normally commit long lead generator, and that like those generators need multiple days to start. Of course, we know like this week ahead, you have a lot of uncertainty, right, in the forecast and the generation availability, fuel availability. So they normally will put some kind of margin in their process, not just to meet the point forecast, but also additional uncertainty. And then the most of these generator cleared in the day-ahead market, and then after that in the intraday, most of these ISO has this called look-ahead commitment, like in a 8-10 hour ahead or like a 3 hour ahead, they will commit different generator to meet additional forecast change, right? And then in the real-time market, it's every 5 minutes. Even that, there's things can happen in the system, like for example, all like a sudden loss of a generator, or there's even within 5 minutes you could have large change in the renewable, and then so this operating reserve, like a regulation spinning supplemental reserve, are procured really to bridge the gap between this real-time dispatch and the final actual system condition. And then with the portfolio evolution, with more weather-dependent resource, there's a larger uncertainty, that are not originally covered by this operating reserve. So this most of ISOs introduce the new reserve product, like a flexible ramp product, or some like a 30-minute, 1 hour product, really to cover these additional uncertainties through market. But outside of the market, the operations normally have this process to kind of study different scenario. The operator, they do run different scenarios and cases, and then to be prepared for system condition change. And then we mentioned like they normally will have some kind of margin in their commitment process, make sure not only to cover point forecast, but also additional uncertainty. And then also there's like out of market actions. It's actually necessary because the market, just day-ahead real-time market is not actually very granular enough to manage all this uncertainty. And then the typical US market clearing system include 2 main components. One is on the security constraint unit commitment, and the economic dispatch is the optimization. It basically take the offer bids from participant, and also like the ISO also has enabled this transaction, physical scheduling, import, export schedule from neighbors. And then all these kind of information fit into the market clearing system. And then these are translated, basically all these tariff rules translated into a large optimization problem. So this optimization, really the objective is to maximize social welfare. And then in the end, most of the problem, like in the US, is formulated like a mixed integer programming or linear programming problem, and then sent to the MIP and LP solver. And then on the other part is on the transmission security, right? So ideally, you should have this problem together, form a like a large global optimization problem. But the issue is like transmission system can be very large. Like for example, I worked at MISO, like a MISO network model has about 45,000 bus, large system. It's not only just their own territory, but also, their neighbors and the major portion of the Eastern interconnection. And then based on the NREL rule, they not only need to maintain the base case security, but also N-1. So like a MISO has 15,000 like monitor the line, you need to ensure security under all the N-1 condition, right? So it's nearly impossible to have all this large network model included into the optimization. So they do it like a decomposed way. So after you solve like an optimization, the solution will be fit into the network security analysis to perform like a power flow and continuous analysis. And then if any of these violation is identified, then they only send this potentially like a violated or binding constraint into optimization. So it's kind of iterated like that. And then in real time, you have the state estimation and the continuous analysis. It's on like a rolling basis. These identified constraints will be added into the real time security constraint economic dispatch. It's normally like a normal days, maybe a dozen or a couple dozen, but stress day could be a couple hundred, fit into the real time scale. And yeah. They had basically after they had normally operator, like a grid operator will put a set of they call the watch list constraint. So like based on historical clearing, their set of constraints routinely binding. So they will just put them into the optimization, from the beginning. But after it's solved, then they will run the kind of a power flow continuous analysis. It's normally DC power flow, but in some area like California, they also run AC power flow. And then if they call it SFT, simultaneous feasibility test, that will identify additional constraint to be sent back to the deadhead clearing. So the deadhead security constraint unit commitment is generally include these kind of objective and constraints. So the objective we say maximize social welfare, but today there's a very limited kind of demand side participation. So in general, it's like a minimize production cost from the generation side, and then also minimize the violation penalty. And then the constraint is there's some major constraint, including this resource constraint. So this like a US market formulate very detailed like a generator specific constraints. We have it in the maybe next slide. But the good thing is like most of these resource constraints, they are kind of decoupled by resource, right? Or there might be some kind of resource group like a combined cycle group, and then but in general they're decoupled by resource or resource group. And then there's another set of system-wide constraint like a transmission flow and then power balance or reserve constraint. Those are kind of coupled across different resource, but they're kind of decoupled by time. And so these kind of characteristics sometimes can help to develop the like a market clearing algorithm, the solution algorithm. And then on the network security side, yeah, we mentioned earlier, you have to not only ensure base case security, but also N-1. And then so in reality, there's a real world this AC power flow. So DC, there's a gap between the two. So grid operators, they developed, some different ways to manage this large scale, and then the inconsistency between the DC and basically linear approximation and the actual AC power flow. So it's I mean, after working on this for so many years, I just a lot of time being amazed by how grid operators can be very creative in developing different ways to handle this kind of complexity. And then this one is just a summary of the clearing variables and constraint and the kind of the size. So on the supply side, we have the generation offer, like larger ISOs, for example, MISO has 1,400 generators. And then there's a transaction, from external, it's dispatchable transaction, import or export. And then also, Erik mentioned earlier, there's a virtual supply and demand. It's virtual really was introduced to bridge the gap between day-ahead and real-time, basically drive the convergence. And then transmission constraints, can also be large, and then the number could be large. Like, for example, operator normally select a watch list constraint. This can be like 7,000 or 10,000 in that range, and then it will iterate with network security analysis. So these kind of security analysis, the network model could be like 45,000 bus, right? And then there's also a large number of contingency you need to evaluate, and then feedback the potential violation to the optimization. So when I was at MISO, worked a lot on improving the market clearing process. MISO started maybe with solving the day-ahead in 5-6 hours, then gradually improved to 4 hours, eventually like 3-hour market clearing time to ensure, for example, gas unit after market clearing, they will still have time to go to the gas market to procure fuel. Really, all these complexity have a kind of impose a great need to improve the technology and the computation performance in the market. And so like a resource constraint, like in US, it's probably unlike Europe, we model very detailed resource constraint. Like a thermal generator could have like startup states, like a cold, medium, intermediate, and warm. Start time and cost based on how long the unit was off, right? And then there's a minimum uptime, downtime, and then start the transition, and then max uptime, and then also generator has capacity ramping constraint, and then maximum number of start or maximum daily energy. So for this fuel limited resource, and then also on the ancillary service, like a reserve market, sometimes some ISO also introduce like a reserve commitment and the capacity constraints. In some ISO, they also had another complexity. Like for example, California ISO ERCOT SPB, they have configuration-based combined cycle. Basically, the combined cycle plant, you could have multiple combustion turbine, steam turbine, and then steam turbine was really it's fueled by the waste from the combustion turbine, and then so there's a dependency, and then so this multi-configuration based combined cycle model will add another layer of complexity. But in some other ISO, like ISO New England, they basically introduced like a megawatt dependent ramp rate, so that to capture some of this, but without getting too complex in the mathematical model. And then recent years, there's also storage participation. The storage has this state of charge limit, right? It's tempo dependent. It's really can introduce a lot more computational challenge. But most of these ISO today are basically they don't kind of manage state of charge. It's leave to the owners to manage that. So in this operational, so we started with the uncertainty management. So really you have this optimization, but today it's mostly deterministic, right? You feed them in a set of input, then it will solve a single kind of snapshot type of optimization problem. But we all know the system has uncertainty, so you can't just use, point forecast just to meet that. Then we all know this input has a lot of uncertainty, right? These load forecast, wind forecast, solar forecast, these are imperfect. And then also generation availability. Sometimes, the generator may appear to be available, but when you get into real time, you found out they may actually not have fuel, or maybe, may not be able to start, especially in the cold winter season. Some generator, you commit them, by the time they need to start, they all of a sudden they cannot start. And then also there's a net scheduled interchange from external. These have a lot of volatility in real time. And then there's some derivative uncertainty, all these uncertainty, when you put into the large system, you could have transmission congestion. This is actually very difficult to predict. It's most difficult to predict because all these other uncertainty, there's a ways to quantify, but the transmission congestion can be very complex, and then it's really difficult to predict the congestion ahead of time. And then there's also response from participants and also grid operators. They may have different risk appetite and then respond differently. And then, so all these, will introduce a lot of challenging for the operations. And then especially in recent years, there's a more frequent extreme event, how to predict that and then take appropriate action. And then, so, on this individual component, you may be able to figure out a way to quantify, the uncertainty, but, the aggregated uncertainty become even more difficult to quantify because there's a correlation between all these different components. Okay, so I think Erik probably will summarize the commitment process.
I think we'll just do this and then we'll move to a break before Jean's part, just to kind of wrap up this, the US portion of the timelines. So this one's really, why I think this is really important is this is, has a large impact on how forecasts are used, is this day ahead commitment process. So here's kind of how the day ahead commitment process works in its entirety. There's some differences across the regions, as you all know, and as we really highlighted throughout the presentation today. But kind of going from what Yonghong has already shared, we have all this information that is going into the day-ahead market clearing, and that includes bids of demand. It includes these financial virtual bids or increments or inks and decks, and includes the renewable resource offers. So if a renewable resource says, I'm going to operate at 0 tomorrow because I don't really want to participate in the day-ahead market, that goes into the day-ahead market. So after all this happens, the day-ahead market clears. It has schedules and it has prices for the day-ahead market. And then it does one more step. And it's what's often called a RUC, reliability unit commitment. There's a lot of other names for it. But this reliability unit commitment is basically going to look at what the day-ahead market had determined of what units are being turned on, and then goes and does another check to see if it needs to turn on any more units. What's unique here is, as you see, this is where the forecasts are used into that process. So forecasts are not used in the day-ahead market unless the individual resource is using its own forecast, right? The ISO forecasts are not used in the day-ahead market. And there's also some other changes of trying to combine these, but this is where the forecasts are used. Now, what happens, and this is where it's really important to recognize what is the value of improved forecasts. There's a couple of these steps before there's actually a commitment that takes place. So first, is the forecasted load higher than the bid-in load? If it's not, or sorry, if the forecast load is not higher than what the bid-in load is, there doesn't need to be anything to happen, assuming transmission constraints don't impact. is there already enough capacity that we've cleared in the day-ahead market to meet that forecasted condition? If there is, I don't have to do anything. Is there enough quick start capacity that I can turn on later? If there is, I still don't have to do it. I don't need to do anything in this process. So only if all these steps fail, then the commitment process will turn on another unit that wasn't cleared in the day-ahead market. So that's where the importance of the forecast comes in. Only after all of these other steps that it would have this additional decision of turning on additional resources that needs. Where this might be changing soon is how to treat storage as part of this, because storage is another, it doesn't have a commitment like thermal resources to turn on, but it has a temporal impact, right? So you need to know whether I need to make some decisions earlier in the day that will affect later in the day. If I need to use that as part of this reliability process, then I need to know that information.
So just before the break, we had a long session on how the schedule works in the US. Now let's have a look at how it works in Europe. And as I mentioned at the beginning of the presentation, in Europe, we have two separate markets, one for power, the other one for ancillary services. Let's now check how the operation works mainly for power. And to do so, let's have a look at the sketch that is there above. On the top, you have what power exchange are responsible for. And on the bottom, what system operators are responsible for. And here you can see it's really the operation in day ahead. This starts in day -2 for delivery 2 days afterwards at noon. So the first step is the transmission system operator. They work together and they create a common grid model out of the different grids. They also have a list of outages that will take place in real time, and they also make some forecast of the load and of the generation at each nodes at the transmission level. They run some scenarios, and based on that, what they get is some capacity, cross-zonal capacity, really the capacity that there are on the lines between the countries. So those inputs, they are given to the day-ahead market, so SDAC. And aside from that, also SDAC receive as input some bids from the different market parties. The market clears. When the market is clear, we have a better view on what will be exactly settled, and also the generation units send their set points to the different TSO. At that moment, we have another intraday capacity calculation. So TSO again recalculate the available capacity between the different bidding zones. And so I was saying we have the day-ahead markets where we have some exchange, but people then afterwards can still adapt their bids and adapt their position. And they do that throughout all the day, throughout intraday coupling. And this is done through three different auctions. The first one is IDA1, which is operated at 3 p.m. Then we have IDA2 at 10 p.m. And then we have IDA3 at 10 a.m. For the delivery date at 12 of the day. And in between, you always can adapt your net position through continuous trading. I'll explain to you what it is, continuous trading, just afterwards. But what it means is that during intraday in Europe, there is never a stop, meaning you can always trade energy through auction, but also continuously with other market participants, just to adapt your net position. And in Europe, mostly we have plenty of liquidity on the day-ahead market. 30% of power is sold on the day-ahead market. Then you have quite a lot during the day also. I don't have the exact figures, I'm sorry for that, but this is done through the IDAs and also XBIT, which is just continuous trading. But let's have a look at what is continuous trading in practice. In the US, you only work with auction through the unit commitment or through the schedule. What it is market participants that are willing to produce or to consume. They submit their bids. Let's keep it simple. It's just a volume, a price to their power exchange that they are willing to produce or to consume during the day. After gate closure, we put all the bids together. What we do is we try to maximize the welfare, and we also take into account some network topological constraints. And what's the auction going to provide is the optimized cross-border flows between the countries, the price, and the volumes. there is one unique market price per bidding zones and per market time unit. While continuous trading, it's a little bit different. There is no common auctioning and there is no unique market price. How it works is there is no real gate closure. People can submit bids whenever they want on the exchange platform. They say it's a sell bid or a supply bid, a certain amount of volume and a price. And from the moment that two bids match, meaning each of them are accepting to each other, they are settled together. So we don't optimize. It's just the first in, the first that come in and then accept the bids is accepted. So there is no unique price per bidding zone and per market time unit. It's really depending on the contracts between the two market participants. And for there, you also don't price capacity between different regions, because for continuous trading, we also allow tradings between different countries, but there you don't price capacity, so flow capacity. While when there is an auction, you price the flow capacity through congestion rate. How the auction in Europe, so the European auction are cleared. And let's introduce Euphemia, the most beautiful algorithm in the world. That's co-created by Inside, but it's the property of the power exchange in Europe. What it takes as input is market data. Those are like orders. I will introduce them a little bit later, what type of orders we have in Europe, because they are way different to what you have in the US. And aside from that, it also takes into account network data. So what's network data? It's, for example, the different bidding zones that's fixed over all the year. It's always the same. But you also have network topological constraints. There are approximation of the network topological constraint, because we don't have all the information at the nodal level, but at the zonal levels. I explained to you, we have different type of constraints, ATC or flow-based. You also might have some constraints for HVDC lines, line ramping, transmission tariffs also on some lines, or losses. Euphemia takes all of that as input. It takes 7 minutes. It finds a solution that is very close to optimality in terms of welfare. And what's the output is the executed volume for each market participants. So what is accepted, what is refused, the network flows, and also the market prices. So the network flows are commercial. Yes. I said 17, sorry. Yeah, sorry. So it's 17, you're right. So it's 17 in their head, 7 minutes for intraday auction. And for their heads, what happens is that 12, you have gate closure, 12:10, you start the computation. So normally it finishes at 12:27. Then Power Exchange deaggregate the orders, transmission system operator check if the solution is feasible. And this is published at 12:50 almost. So those are aggregation of resources which are represented through a unique market offer that is given to the market. So let's imagine you have a generation unit which has, so it's shown there, which has wind turbines and batteries. What it's going to do is, instead of doing two different market offer for the market out of that, what it's going to do is going to aggregate those bids together and have, using some forecasts on how you can operate it or other things. And it's going to create one offer that will be given to the market. And that can be with very different mix. Yeah, it really depends on what you can generate in practice. Then the market clears. The market gives as output the volume that is accepted for each market offer and also the price. And based on that, the portfolio owners afterwards, they disaggregate the market outcomes. So they know they have a volume that they need to procure to the market, but they can decide afterwards how they procure it. So they could say, let's say, I don't know, this portfolio is accepted as half. I will only procure through using wind turbines, but that's my choice. It's not the market's choice. It's just because what I offer is a market offer, which is simply a price and a volume. And then I can choose how I optimize my own portfolio. But still, I need to announce to the transmission system operator, because they are the one who are responsible to operate the grid, the set points of how I'm going to operate, of how I'm going to schedule my generation. And so this is done after the market. Those information, they are not translated within the market. And let's now have a look a little bit more on the different bidding products we have in Euphemia. So the first one, and the simplest one, is just hourly orders. What do they so the input that is given to the market is simply a quantity, so an amount of volume that you are willing to produce or to consume for a certain price at a certain time period in a certain bidding zone, Spain, France, Belgium, and you need to define if it's a buy or sell. So those are the simplest orders that we have in Europe. Aside from that, you also have more complex order called block order. So those orders are indivisible, meaning you can only accept it or completely, so fully accept it or fully refuse it. For those orders, what you need to give as inputs are quantities. So it's not quantity, but quantities, because it spans over multiple time periods. It can be the minimum amount of hours is 4 for the moment in Europe. And you need to define price, time periods, and bidding zones at which they would be active. And what are they used for? Because it's binary, it's often, for example, linked to some power plants, gas power plant, or maybe coal power plants, or even nuclear power plants, because it's only turned on or turned off, and it represents better the fixed cost for those type of assets. Those are the reasons why in Europe we have a mixed integer problem to solve. And those orders, so those block orders, you can link them together. For example, you have parent-child orders, but you could also have link orders, meaning you can accept one only if the other one was accepted. The two orders, they might be of different type. One might be a buying order, the other one might be a sell orders. And what's the purpose of that? It's, for example, you could use them to represent batteries or also ramping constraints. You might have different possibilities for your power plant to expand. And then we have orders which are more similar to what you have in the US, scalable complex order. There, they are represented with a fixed cost, quantity and price, and also time period, but that's the case for every order in practice. So the fixed cost is independent of the activation level, and the fixed cost, what does it represent? It really represents the startup of the power plant. You have a minimum acceptance volume for each hour. So it's to better reflect, for example, the technical constraint of a power plant. We have ramp condition between different periods. So again, physical constraint of power plant. And it requires binary variables for each market time unit, simply because you need to define at what time this power plant will start up and when it will shut down. It can only start up once over the day, which is different compared to what you have in the US, where you can start up multiple times. Here it can start up only once. So that's really closer to what you have in the US, but it's not used everywhere, only in Spain, Italy, and Ireland.
Probably a bit quicker, because I think a lot of these you've already seen. Is Justin still? He might have left, but I took this slide from Justin just to kind of show all of the different, timelines and different mechanisms where, weather data is accepted and forecasts are accepted. So, of course, all the way from a long-term planning perspective, especially with FERC Order 1920, that's looking at 20-year ahead transmission planning and trying to get that type of scenarios and different scenarios within the planning process, all the way into, I need to know what the conditions are 5 minutes from now so that the dispatch I've just told all these resources to go to is the right direction for them to go to. And of course, everything in between. So we'll kind of just quickly focus on the operational pieces. So Yonghong, I might skip these just for timing to get to the part here so we can get into the grid services piece. So, this is just really looking at all of the different types of inputs and processes and all of the types of things that go into all of this. So we have, load forecasts, renewable forecasts, fuel forecasts, and then we have, offers, contingency data, all of this type of data going into these different scheduling processes. This is kind of how it exists today. We have all of these forecasts going into these as inputs into these different scheduling processes. We already talked about how the day ahead market and the day ahead reliability unit commitment, how they use those forecasts differently. But then there's all this other things on the bottom that are somewhat static in the past. And what I would like to show is just how some of that is changing. So, again, this is kind of where we are today, where you have these forecasts on the top and this static data, on the bottom. And going forward, we have things like reserve requirements that are being forecast. And we'll have some of these slides are teeing up the rest of the workshop. So forecasting, the forecasted load levels, the forecasted renewables may affect how much reserve you need. What are the types of conditions? Fuel forecasts, that can affect what different types of, reserve requirements are necessary. In the winter, when you have fuel limitations, it might mean different operating conditions, different reserve requirements that you have. Another thing that might be changing is, contingency analysis with forecasting. So anticipated load needs may impact critical conditions, critical contingencies, how much renewables, what that forecast is can actually impact the types of contingency analysis that you have. Having those low probability scenarios can be part of the screening, and then fuel issues, can actually be used as part of the preparation within contingency analysis, all kind of using that forecast data. And now, again, looking at how these bottom boxes are moving from static input data into, changing input based on forecasted conditions. Fuel forecasts, how to align those fuel forecasts with fuel markets. All of those financial offers actually using the forecast to guide how they're participating in the market, including renewables participating in those markets. Energy storage, using that forecast to inform their bidding strategy. These are all things that are starting to change where these forecasts are being used and where different forecasts are starting to be used. Another one is around transmission limits, realizing that transmission limits are not static values. So actually forecasting what the limits are based on temperature and wind speed, and even incorporating that into fuel delivery, pipeline limits, and so forth. So this is just a really quick, run through of how forecasts are being used in these different scheduling processes across those different tools and how that's evolving going forward. And what's evolving is these static values we realize are changing and that they require things like weather data and other inputs to forecast them. But what we're also learning is that those forecasts that maybe we know are being used in a lot of different ways. It may not just be the ISO using one forecast for its reliability purposes, might be used in market participants and all of these different types of ways going forward. So any questions? I know it was really quick. Session on reliability services. So I think I'll try to kind of skip around a little bit just so we have time at the end for future thoughts from the group. But had some questions around what are ancillary services or what are grid services. So here's one kind of diagram to look at some of those that are out there. And even this is not necessarily comprehensive and including all of them, different names, et cetera. But you kind of have the active power operating reserve on the left here that's kind of broken down into these different categories, split into like what's driving the need for it, as well as the timing, kind of the response time of these. And then you have planning reserve, which is more about, what needs to be built in some future time frame. We have voltage control, reactive power reserve, and static and dynamic versions of that. You can break that into a couple of different categories as well. Black start restoration, short circuit contribution. We have inertia kind of here as a reserve product, even though it's not really necessarily a reserve product, but it kind of fits within those timelines. So there's a lot of these different services. There's various requirements for these services that may be through NERC compliance or NSOE, or regional requirements as well that determine who can provide these, how much, what's the quantity that is necessary for each region or balancing authority to procure or to have within their system, and then things like what types of responses are necessary if these events happen once you have those types of products. So I'll also mention here that well, we'll probably skip around anyway, but mostly we'll talk about these reserve products within today's talk. And if anyone's interested in some of these other ones, there's lots of really good ESIG material I can point you to, and other types of reports and studies that can really share some educational material on all of these different services. So I wanted to go into frequency response first. So with this, you see that we on the red is the frequency going to the right-hand side here. And then what also showing, this is a diagram that came from NERC example, which I think is really useful to see what's happening across when an event occurs. The purple here is showing the load response. The black is showing the power deficit. And then the dashed yellow is showing the inertia that's happening through time. So as soon as that event happens at time 0, you start to get a drop in frequency and you get an instant increase of energy from the balancing inertia and a little bit of load damping that starts to happen. So you see what that mechanical power difference is here. So we lost 1,000 megawatts, frequency starts to decline. That rate of change of frequency is based on the synchronous inertia that's part of that system. So that continues to happen, and you see we're getting a little bit more load damping. That load damping is allowing some of that inertia to back off a little bit. And then at some point, we're starting to get a response from the supply resources through their governor control. And one thing that's not shown on here is what we talk about as fast frequency response, or something that might come in through a inverter control that has that activation when it senses that frequency. But once that governor control or primary frequency response starts to be activated in the blue, now you're seeing that it's balancing out that deficit and allowing the inertia to steady, right? So the speed of the machines is now at constant, is where you're seeing that frequency nadir. That decline is arrested. So that's the primary frequency response. You start to get a little bit of oscillation to get to a steady point, steady state point, where you get the full amount of frequency response, typically around 20 seconds after the event. And you're seeing all those responses together here. Now we're at a new steady state frequency that is below what the scheduling frequency is of the system, which is 60 hertz in North America, 50 hertz in Europe, and some other parts of the world. So let's say in this example, we started at 60 hertz and our steady state frequency is, let's say 59.85. So that steady state frequency then continues and balances out. And of course, we want to bring that frequency back to its scheduling frequency, so that if another event were to happen, what we're concerned about a number of things, but one of the things we look at is at some point, if the frequency gets below a certain level here, then we'll be tripping off load. Right, so we want to avoid that for credible events. So that means if another event were to happen here, and you have the same loss of frequency as you do here, let's say at 59.7, there's under frequency load shedding. If we don't get this frequency back to 60 hertz, we could have that load shed event. So that's where the secondary frequency response, or what we would call spinning reserve, comes in to then correct that frequency, or the automatic generation control to bring that frequency back to its scheduled level. So very quick overview of sort of all these different services that support frequency control and kind of what's happening across those timelines. This is maybe a little bit of a detailed slide, but one of the things that I hear often is just a confusion between regulation reserve and primary frequency response. So this is just kind of describing the differences between them. I'm going to skip it because it's a lot of content, but if anyone has questions on this, I'm happy to talk through it, during lunch or at one of the other breaks. And maybe just kind of lastly on sort of the reserve needs is, talked a little bit about why, there's requirements for certain quantities of these different products. What are some of the reasons, what drives that? So in US and in Canada, a lot of these products are driven through some of the NERC balancing standards, the BAL standards. So I'm going to kind of go through how each of the standards impact them. And I think John may talk a little bit about how that's similar in Europe. So for regulating reserve, there is not a NERC standard that says a balancing authority has to have a minimum amount of regulating reserve. So that's really up to each balancing authority, just or an ISO RTO if they have that type of a reserve product. But there is a performance standard that says if you have this much imbalance, you will be penalized through these NERC standards. So there's actually two with the BAL1 standard, control performance standard 1, which is a 12-month average of 1 minute data to see how much negative impact a imbalance on a balancing authority area has on the frequency. And then the balancing authority ACE limit is essentially a large excursion of ACE that can happen, or it's sort of dependent on the frequency error on the system, that if you exceed that limit for more than 30 minutes, there can also be a performance violation through NERC. So those performance standards really drive the quantity of regulating reserve without having a requirement for how much a region should have. On the other hand, there is requirements for minimum amounts of contingency reserve, and that's through the BAL2 standard, also called the disturbance control standard. And essentially that's requiring a amount of this type of reserve that is greater than or equal to the most severe single contingency within a balancing authority, and that has to be corrected within 15 minutes. And then finally, BAL3, the third standard on the NERC BAL standards, is really requiring a minimum amount of frequency response through the frequency response obligation. So that has a minimum amount of megawatts per hertz for each balancing authority. That's based on a number of criteria, based, with an N-2 event essentially across the interconnection, and that's allocated to each balancing authority. So that essentially drives a minimum amount of frequency response with each balancing authority. And so there's no NERC requirement for the tertiary reserve, sort of like a replacement reserve for contingency, but there might be some regional requirements for that type of a service. For example, in Northeast Power Coordinating Council, there is a requirement to have 30-minute reserve that is equal to half of the second contingency in a region. So that would require that additional reserve product. And then finally, we've heard a lot about ramp products, uncertainty products. These are not linked to any of the NERC standards. These are things that a market region might add because they've seen some reasons that it can help based on economics or based on reliability, and that these will be added regardless of what those NERC standards have. Any questions before? Yeah, so that's this last bullet here. So basically, that's so that's not a NERC, that's not NERC saying you need to have this much because we see a reliability issue that we think this can address. This is each region deciding that it has some value. And it could have been because there were some significant short-term price spikes that it helped resolve. It could be that, the markets are just not getting enough flexibility if they didn't have these products, but there's a number of reasons why, a particular region sees the value, and, not just market regions, other non-market regions have introduced these as well. But NERC has not done anything with these types of reserve. This is just kind of our way of showing there's some differences across North America and Europe, of course, in the terminology that's used. This is a kind of a quick comparison of some of the terms that are used between the two. And, of course, this is something we try to track all the time because a lot of these new products are changing, it seems like every year. So just kind of knowing how these relate to each other is something we some really good questions throughout this morning. So whenever there's good questions, it also means that you don't get to every slide. And I think three of us also had a chat earlier, was it last week? And we're like, yeah, we have too many slides, but we're not sure which ones to take out. So, so they're all there. And I'm really actually happy with how much content we did get to. So I'm not even going to read through some of these. This is just more for reference. What are some of the initiatives that the U.S. markets have in place right now? So they're looking at multi-day markets. They're looking at renewable dispatch enhancements. State of charge management for batteries is something that's being looked at. Changes to the electricity markets, adding nodal markets in the Canadian ISOs. And using these dynamic transmission line ratings. And then for ancillary services, we're seeing a lot of initiatives from the market regions to add these dynamic requirements. We'll hear about that, I think, tomorrow at the workshop, requirements that change based on system conditions, introducing new products, these ramp products, improving reserve deliverability. Yonghong has been working a lot on that. Adding day-ahead or real-time ancillary service markets, changes to the shortage pricing, and then one of the changes that happened that started last year is the elimination of payments for voltage support. So another kind of change to the ancillary service markets when in the standard power factor range. So anyway, that's just for reference. There's a lot more info on all of these if you are interested, but maybe next I'll hand it over to Yonghong. We probably need to just capture the key points of,
Yeah, I have quite a few slides, but we'll probably just focus on some important areas. So I think in general, with the electricity market, you want to achieve three goals: the economic efficiency, incentive compatibility, and the revenue sufficiency, right? So, I mean, there are challenges like in the existing market, especially with renewable, the reduction of the marginal cost, and then how we can provide enough incentive for investment, and also capture the need for uncertainty management. So this one just to summarize some of the recent effort in improve the electricity market pricing. The first one really is on the non-convexity. We discussed a little bit early, all these generators fixed cost, how we can reflect that fixed cost rate to avoid this side payment. And then there's also like an emergency capacity or in like to be like even broader is all these out of market actions. You know, these can kind of sometimes causing price depression and so I mean it happened in the past when you have an emergency event, sometimes the price actually are very lower just because a lot of these actions out of market. And then how to make sure the market will give a right price signal. And then in the end, you know, we talked a lot about the reserve market. You know, in general, the market has this called the operating reserve demand curve, this kind of ORDC to reflect the value of the reserve. But some of the issue is like at the very tail end, you can see it's a low probability event. Because it's low probability, so the demand curve is value is very lower. But when you really need that in this extreme condition, it's not enough to drive the clearing of this product. So, you know, whenever, just from my perspective, is all these need to be more conditional, kind of reflect this conditional probability or need. You know, because sometimes the operator even intuitively they know in certain condition there's a more forced outage, right? You probably need to carry more reserve. So that kind of lead to. Oh, sorry. Okay. Yeah, I have quite a few, but I probably will just summarize. In general, I think on the reserve product design need to be more dynamic instead of a static requirement. Like traditionally, the contingency reserve to cover the largest generation outage, but we know, you know, some of these audience, you already asked about what if the reduction of renewable can happen quickly and even on a much bigger scale, right? And then I think this already happened like at the MISO, the wind forecast error, you know, coupled with some load pickup can cause significant amount of kind of ramping needs in a very short time window. And then so how to kind of predict this kind of event and set up the reserve requirement more dynamically, you know, because if you always cover the worst case, it could be 5,000–6,000 megawatt. You know, it's going to be very expensive to the market. And so if you can be smart enough, say, you know, some hours I only need 2,000, some hours maybe, you know, 6,000. So that can bring a lot of efficiency. And then in terms of location, so in this large system, normally you don't see system-wide kind of emergency very often. In most of cases, it's like the regional or sub-regional. So the issue is like how can you identify the right transmission constraint and then to clear reserve at the right location. So that's an even more difficult problem. Like we mentioned, MISO has 15,000 kind of monitor the line. You won't be able to identify the subset of transmission that can cause you problem. And then also in the post contingency, you know, you won't be able to transfer from outside. You need to carry enough locally. So that's also a very kind of interesting and challenging problems. So I worked a lot when I was at MISO on this specific issue, but still it's still like you can maybe handle it on a sub-regional level, but go into more granular, it's going to be very difficult because reserve can be deployed in many different ways. And then, so in terms of reserve product itself, this question from the control room is like how I can ensure this procured reserve will be available when I need it, right? Do we have enough incentive for them to procure fuel and then to show up when you need them? So there's a whole set of, you know, question of how to incentivize that. Some are actually went all the way back to the, for example, capacity market, like Erik mentioned is pay for performance. Basically, if you don't show up, you will get a huge penalty. But we see in some of these extreme scenario, you know, from the asset owner side, it's hard for them to predict and to be ready for that. So end up with like a huge penalty, but it's not a really a good solution. And then, so how can we kind of make sure? But I think ultimately all this discussion on the forecasting or this, especially during extreme event is extremely important. If we can forecast that and then give a right price signal, and right reserve requirement, right, and payment compensation, people will show up. But if you can't forecast that well, and then they also don't have a good idea, they will take chance, right? So, and then, so I think we covered that statical dynamic and the deliverability, you know, in terms of basically location. And then goes back to the coordination. I think there's a complexity on the reserve market. Is like every ISO have their own definition of a reserve product. You know, there's some common ones, mostly driven by the NERC standard. But then some ISO introduce 1 hour product, another is 30 minutes. But if I mean, in the future, there's a potential need of more reserve sharing. I mean, today we already have that in some of these regions, but there's for example, merchants start to build a large HVDC interconnection, like an interregional HVDC. You know, the single largest event could be very big, and then it's hard for individual ISO to cover. But then if you want to do reserve sharing, and then if you don't even have a common definition of reserve, that can introduce, you know, another layer of complexity. Okay. Yeah. No. No, even in day-ahead, you can define like a, you can, for example, forecast the uncertainty or condition like in the next day, and then you may be able to adjust the requirement even in the day-ahead market, right? Yeah, and then on real time you can like do a continuous kind of improvement. Yeah. Okay. I think that's okay. I think that's probably most of the areas in the US.
Thank you. And related to your last question, my colleague who is just there is going to present what we do in Europe, how we dynamically size reserves. Yeah, for tomorrow, I think. And I just selected a few challenges that we have in Europe and also what we're going to do in Europe in the next year. So what you have seen normally during the presentation is the difficulty in Europe. It really relies in the collaboration between the different countries. We have to collaborate with many different entities, more than 30 TSOs, 17 power exchange. It's quite a lot to make sure that they all agree. So it happens that we don't go as fast as the US on some market design issues, but we are moving forward. I was telling you the day-ahead market was at 16-minute time unit. It's going to move to 15-minute time unit, market time unit, sorry, in September. Why? It's mainly to better integrate renewables, and it's also linked to forecasts. Forecasts are better 15 than 60, simply because some solar power plants cannot keep their balance for 60 minutes because it will depend on clouds or other physical stuff. I've been speaking quite a lot about our pricing methods. So we have marginal pricing with no PAB. We plan potentially to move to non-uniform pricing, meaning we would introduce side payments, but this also creates quite a lot of issue, mainly on the power exchange side, because it would mean that power exchange would have to pay those side payments, and they are not that much willing to do that. It could also be market participant paying for it, but how do you compute that? Is it based on the welfare, other condition? We also plan to introduce new bidding products. So I've shown it to you before, but the products that we have in Europe, they are quite rough. They do not represent the physical constraints of the asset. They are mostly economic products, but some assets would need new bidding products to be to generate more money into the market. And there are some products we want them to generate more money. Here I'm mainly speaking about storage. So we plan to introduce storage orders, mainly state of charge. And finally, the last one, that's really in the long term, maybe in 20, 25 years, would be, I would say 20 years, to have a couple markets of energy and balancing capacity. That would be difficult to introduce, mostly because we have the power exchange that on one side handle the market, mainly the power market, while on the other side, we have TSO that handle the balancing capacity. And making such that they work together would mean creating one entity that handle them all. That would be complicated, but we are moving forward to it. And mainly it's really important because it would increase the liquidity in the market, reduce the price of electricity, and also reduce the needs that we have. That's it, I think, for the future looking of Europe. Maybe you want to have a last word, Erik?
Yeah.
Sorry to give you that.
Perfect. Thanks, John. So, like I said, we'll have these slides available just like all of the workshop slides. So there's a lot more in here. Certainly don't hesitate to reach out to any of us if you have other questions or would like to talk about things. Just kind of showing up the 5 objectives that we put earlier on at the start of today's session. I know we kind of got rushed a little bit on the last maybe 1 or 2 parts here, but I think we did get a good chance to go through all of these, and I hope you feel that you learned a bit more today from learning about both U.S. and European markets from the session. Any feedback on today's tutorial, please share that within your ESIG feedback forms that get sent to you about the whole workshop. We'd love to know how we could do these better and what types of topics we can include going forward and so forth. So anyway, I'd like to first I want to thank John and Yonghong for volunteering to participate in this today. And thank you all for coming. Really great questions throughout this morning. Just really kept the dialogue going and made it so it wasn't just us talking. Some really good questions, really a lot of things I think we learned from hearing from you all today as well. So appreciate that. And I hope everyone has a good conference. Lunch, Lacey, is that downstairs again? So lunch is where breakfast was. And then where do we meet after lunch? Is it back in this room for the main conference? So thanks again, everyone.